So now I'm going to give you a strategy of how you can implement the breaker block, and I've been able to classify it into steps. So we have the step 1, step 2, step 3. Very, very easy for us to use in our charts. Now this strategy is designed for a swing trader, but you can as well use it for day trading, scalping, and even short-term trades. In overall, you're going to be working with 3 major time frames. Now I would like to say it here that whenever you are creating a strategy or whenever you're working with a strategy, you don't want to use too many time frames. You want to work with few time frames. Just like the lecture I give on selecting setups with time frame, you want to have 3 time frames: a long-term time frame, intermediate, and then smaller time frame for your entries. So step 1, you're going to be looking at the weekly and daily time frame. What are you looking out for? You're looking out for the institutional order flow. Is it bullish or bearish? How do you determine if the order flow is bullish or bearish? There are 3 things you need to use. Institutional levels, this include order blocks, breaker blocks, fair value gaps, etc. Then the second, you want to be including the smart money tool, where you look for correlated asset to see if there is any divergence in market movement. Then the third, you want to look at the market environment. You want to check the market profile. Is market consolidating, expanding, or retracing? This is very important. All this will give you a story to tell if the institutional order flow is bullish or bearish. And the second step is you want to go to a 4-hour time frame and then look for the breaker block setups. And you'll be using the market structure to guide in identifying quality breaker blocks. I'm going to explain this in the chart. Then the last step, you're going to go down to the lower time frame to find the daily setups. And you will need to include the ICT Q zones, which include London, New York, even the Asian Q zone. And then number 2, you want to use market protraction and market open. Then the last, your entry patterns. All right. So I'm only going to be giving you just one entry pattern, which is very simple. In subsequent videos to be released, I'm going to teach you multiple entry patterns. You don't need to be worried about entry patterns, to be very honest. All you need to be able to do is acquire the skill to tell where the market is going. Just know where the market is going. Your entries don't need to be perfect. You just need to know where is market going, what is the drawn liquidity, what's the order flow. If you can tell where the market is going, you can enter easily into the market and come out easily because you know market movement. You understand the smart money game. All right, so let's start with step 1. So step 1, again, we want to determine the order flow, and there are 3 things basically you need: the smart money tool, market profile, and the institutional levels. Okay, so let's go there. So we're going to be working with these 2 pairs, the USD Swiss and then the odd Swiss. This is what we want to trade. Now, the USD Swiss and the odd Swiss, or this is the Australian dollar, Swiss franc, they are correlated assets. Now, you can see how they've been moving in tandem, but at this point in time, that is the 1st of April to the 3rd of June, you can see that the USD Swiss failed to make a higher high, but the odd Swiss made a higher high here. You can see it here. You can see the divergence. It's very easy to see. So this is smart money too. So it's telling you that market is accumulating and price wants to change direction, giving you clue that smart money is in play. All right. Now, another thing again I explained. Let me go back to the slide. So smart money to check. The next thing, we are looking at the market profile. What is the market doing at this moment? So you can see that market is consolidating. Now, after consolidation, what do we expect? We expect expansion. Now, I want you all to go back to the video I taught on month 2, that's element of a trade setup. You could remember that market usually forms another block when consolidating. So if it breaks out from consolidation, you expect that the other block that was formed, market likely will return to it for a rally downwards, which will form our institutional level, which is the ICT bearish breaker block. You can see that we have 3 things here. We have market consolidating, and after consolidation, we expect expansion, and we are seeing smart money divergence, and then we are seeing an institutional level here. So we start at this point here. Now, something I also point out is that you don't necessarily have to have all 3 things. Like here, you can see we have 3 things. We have smart money divergence, we have institutional levels, and then we can see that market is breaking out from a consolidation. You don't have to have all 3 things. You can just have institutional level, and then you understand that market is coming from a bearish trend. So if market is tracing into this range and then there's a bearish order block, let's say a weekly bearish order block, you can tempt this range, the next range that will be created, to be a bearish institutional order flow. So the major goal is to determine the order flow. Where is market likely to go? The last thing you need to also identify to solidify a bias for your institutional order flow is liquidity. Where do you see liquidity? Now you can see these lows, you can see these lows, and then you can see this low here. And I have explained to you multiple times, market goes to two places. Buy side and sell side liquidity, which is number one, and then number two, fair value gaps. These are the two places markets run to. So if you want to tell where market is going, where is the liquidity? Where is buy side liquidity? Where is sell side liquidity? Where is fair value gap? That is where market is going. So your institutional order flow is not complete until you've determined where market is likely to go. Consolidation, divergence, and institutional level. The next step is we're going down to a 4-hour time frame to look for breakout block setups using market structure. So now let's go down to the 4-hour time frame of the USD Swiss. And we can see market reacting from the bearish order block. Now at this point here, this is the point we are going to be studying from here downwards. Now, if you remember, like, let me just take this out so that it doesn't disturb us. We just saw that market is reacting from this point. So if you remember, I explained the breakout block. You want to see liquidity. This is the bearish breakout block. Why? Because buy side liquidity has been taken and the market broke structure to the downside. You can see this break of structure. Now, once there is a repricing back to this range here, you expect market to sell. So you can see our market rally down. Now we'll be going through price again. Where else do you see market taking liquidity and then breaking structure? You can see something happening here, but it's not clear enough. So we don't use something like this. You want to see something like this. You can see how market took liquidity to the upside and then broke structure downwards. You see how market returned 1 and then 2. Market rallied. Now let's move. So price rallied above the market, but did not break structure downward. And even this count did not close above the market. So this is just a week. But we can see this. You see how market broke above this high, taking buy side liquidity, and then broke structure to the downside. Now we expect that if market returns back to this range, this is the bearish breakout block. It's very easy. You can see how market rallied downwards. Now I want you to note something. You can see that fair value gaps are paired with the breakout block. See a fair value gap here. Let's look at this. See a fair value gap here. And I see fair value gap here. So this increases the chances of the breakout block holding. You don't see something rough. Let me see if I can get an example here. Let's see. Can I get an example? Okay. This is also a breakout block. You can see market price took liquidity here, broke structure to the downside. You see fair value gap, market returned back to this breakout block. The last down close candle, or you could use this one. This is better. This has the down range. So there's a lot. Let me just draw it out here. So you can see how market returned back to it, then rally downwards. Very, very easy to identify. Let's see if we can get on that one. Where do you see there's a run on liquidity? Okay, here there was a run on liquidity and the breakout structure. You can see it here. And the market rallied back into the breakout block. Let me just outline it. So you can see this down close candle. So market took sell side liquidity, buy side liquidity, broke structure to the downside. You can see how price returned back to it. There's a fair value gap, very tiny, but not strong enough. And you see how market rallied downwards. Okay, so let's see if we can get another one. So there's another one here, beautiful. You see this down close candle. Market took buy side liquidity, broke structure, went back into the breakout, but it didn't last too long. Here it can be a trade as well. So I'm just trying to show you multiple examples so that it will be easy for you to identify. Another one is here again. You can see this candle, but it was immediate. This is a bullish breakout block. So price took sell side liquidity. We can see it here. Then broke structure to the upside. You can see how market returned back immediately. So in a 1-hour time frame, we'll be seeing this more clearly. Okay, let's see if we can get more. Can we get more? Let me shrink the chart. Okay, price did not return back to this would have been a good example. So the thing you're looking for is just run on liquidity first and then break of structure. Where do you see run on liquidity and break of structure? We can see something here. Market run liquidity, broke to the upside. See how market returned back, found support, then rallied, but it didn't last so long. And one of the reasons why you don't just look for breakout blocks in the 4-hour time frame or just one time frame is you want to combine a lot of things. You see how we started from the weekly time frame. We want to see if institutional order flow is bullish or bearish. We want to follow the trend. We want to follow the institutional order flow. We want to know where market is going. So it's not necessarily following the trend. It's just following where there is liquidity, and market seems to seek that liquidity. If we can identify that, we know where market is going. If we see a breakout block in a smaller time frame, which is the 4-hour time frame, we can then refine our trades for a profitable setup in a lower time frame for entries. So that's just the whole game. So we can see another one here again. See, market took liquidity, broke structure to the upside. So you can see this up close candle here. The last up close candle before liquidity was taken, and then there's a break of structure. You see how market rallied down multiple times. You have 1, 2, 3, 4, and then boom. You see. So let's just go to our strategy. So like I explained before, the first thing you want to look for is the institutional order flow, and then we'll term this run here as a bearish institutional order flow. Then the next thing you want to go down to a lower time frame, which is the 4-hour time frame, to look for your breakout blocks. And I'm sure we can identify breakout blocks. So you can see very easy to identify. Market takes liquidity, break structure. If market returns, you want to stem this range as a breakout block. So once you identify them, now you don't need to find multiple setups. You just need one, because you are a swing trader. Remember, you could have entered here and then wait for market to run to this low. Or if you miss this opportunity, you enter with this opportunity and then wait for market to run for this low. And if you miss this, why this low has been tagged, come on now, we have this here and it has not been tagged yet. So you can enter here, you can see how market ran to take this side and this side. And then we have this here. So I'm expecting that another breakout block will be formed. Now, if you look at this would have formed a breakout block, but market did not return to this range. So you see liquidity was taken, but market did not return. And if you look closely, there's no any other example here. No any other example. Now look at the breakout block forming. Beautiful. I love this. I'll use this to explain something. You can see how breakout block was formed here, but market did not react. Because why? Institutional order flow is bearish. You don't want to just go to chart and look for breakout blocks. You want to start from your higher time frame. And you can see that market disrespected, although it bounced a little buy. You might be entering here thinking that this is a buy, and then suddenly market changed direction to take this low. So probably we might see a setup here, but I don't want to see any setup here because market is already close to our end game to sell side liquidity. You can see how market started rallying from this point, and then this is where you want to enter. You know, it forfeits the whole idea of swing trading. You want to enter as quick as possible, as early as possible. Good. Now we've identified our breakout block in the 4-hour time frame. What do we want to do? We want to go down to a smaller time frame for our entries. So now let's go down to the 15-minute time frame and see how we can enter. Now, so what are they again? The ICT Q zones. Remember, you have to include the London, the New York, or the Asian, market protraction, and market open. Very important. And number 3, entry pattern. I'm going to teach you just one simple entry. Very, very simple. You can't miss it. I have a lot of entry patterns, but this one is enough. So let's go back to the charts. All right, so this is the first breakout block. Let's zoom in and see what we look for. Remember the 3 things. Number 1, we are looking for Q zone. So this is the London Q zone. We are seeing that on this very day, market is finding resistance on this bearish breakout block. Where in the London Q zone? At what point? Above the market open. So we are seeing market protracting against the intended move into the breakout block at the London Q zone session above market open. So how can we enter? We can enter once market is above the open and at the point of the breakout block. and then setting our stops, we're going to be using something that we call standard deviation. I'm going to be using the Asian range. I've not taught it yet, but I'm going to be introducing it in this lecture. How can you get the standard deviation? So Asian range starts 8 p.m. Eastern time, 12 a.m. Eastern time. So that's the time range. So you can see here, you can look below the chart. You can see that this is 8 a.m. So you can just use this open here. And I think I've shared with you the indicator as ICT Q zone. So this range here. So you want to bring your fib and then measure from the high to the low. The highest high that was formed within this time window. So let me change it. So you use your fib. So you can see it here. So what you are seeing here, duplicated here, is just this range. So from this high to this low, I think this is the highest range here. So from this high to this low, it's the same thing from this point here to this point. So this 1, 2. So this from the distance from 2 to 1 is the same distance from the high to the low of the Asian range. So you want to use the deviation above the range of your breaker block. So this is a bearish breaker block which we've outlined in the 4-hour time frame, that range. So we want the standard, you want to use the standard deviation above the breaker range as your stop. So you'll be putting your stop here. So let me use this tool. This is where you want to be entering at this point, just at the low of the breaker range, and then your stop will be the standard deviation above. You don't want to be putting your stop here. You can see this is 4.5, this is even 4.5, this is 4. So you want to put your stop at the standard deviation above the breaker range. Your entry just at the low of the breaker range. You don't want to be putting your entry here. You might miss it. Market might not get above to this point. So where you could get it is just at the low of the breaker range. This is a breaker blocker. So if you put your stop here, this is how many pips? This is just 11 pips. Can you imagine? Imagine entering 11 pips here for a swing trade. That's actually so powerful. Now, mind you, what makes this refined is that you are selling above the market open, and you are doing this at the London. You want to do that London session, New York session, London close, or the Asian range, either of these time zones. So you want market to protract against intended move. You're not using just any time of the day. You want to use these Q zones at a particular day. Now you can see how market reacted. So imagine taking your trade from this point. Just in 2 days, you'll be making 8%. If you risk 1%, you make 8. If you risk 2, you're making 16. So this is actually so powerful for a swing trade. So if you hold this for, let's see how long, let's just say for this low, 19%. If you're risking 1%, you'll be getting 19% back. If you're risking 2, that's like 38%. So let's look at the other example. Let me take this out. Remember, our range again is between 8 p.m. to 12. So now this is another opportunity. You can see how market, I think it's the same thing again, but this is happening where? In the New York Q zone. You don't want to, you see that at this day, market did not get to this high at London. So you want to wait for market to get to this point at a certain Q zone above market open. So you want to see a protraction against, because you want to sell. So you want to see protraction. You can see this huge protraction. The same thing here. Let's go back. See this protraction against intended move. These are the things you want to look out for. You don't just open your chart, find this, and that, and then enter. No. This is what refines the chart and makes it highly profitable. So you can see how market reacted. So if you want to get your stop, you want to use the Asian range from the range that was formed. So let's use our fib. We can't use this because it's not in the range. So let's use here. Okay, let's go the other way to this point here. So it's standard deviation. So you can see this is 1, 2, 3, 4. So you don't be bothered about the numbers. Where you want to put your stop is the standard deviation above the breaker. So you can say the market did not get to this point. So you will put, let's use this tool. I don't think I know long position tool. You should use short position tool. So your entry will just be at the low, and then your stop will just be the standard deviation above. You don't want to use 5.5 or 4.5. You want to use just 5. The standard deviation, not half deviation. So if you enter here, let's see. Just in 2 days, you'll be getting 11% if you risk 1%. This is powerful. Did you see market returning back? No, there's no need for market to go higher. Because why? Liquidity has been taken here. So once you see this displacement, this momentum, mind you, we are pairing the breaker block with fair value gap. So, and you can see here again, market is running liquidity. Market is running liquidity, which is very powerful, making this move so powerful. So you see that the next day actually market ran. You can also include this in your day trades, this whole idea. So if you see a breaker block happening here, you can go down to a lower time, let's say a 1 minute time frame, and then look for entry patterns to sell, and then your stop will just be at this high to take liquidity below the market, and you would have made profits. Okay, so let me take this. Or another way you can solve it, when you see market reacting from a breakout block at this day, you can wait for the next day. You can see this. Let's say this is the market open. So market opened here. You can see this is market open. So if you draw it out, you see markets above the market open. You can just buy 5 pips above the market open. I mean, you sell 5 pips above the market open, and you can see a market rally downwards. So this is how you can also implement a breakout block from a higher time frame, which is a 4-hour time frame. So let's continue. Let's look at the last example here. So you can see how market reacted here. Now you can enter here because it's happening where? In the New York Q zone. You can enter here at the London. So if you pick your fib, let's use our fib. So this is the range that was formed from this point to this point. Your stop will be here. So let's use the sell position. Stop. This is where your entry will be. This is where your stop will be. How many pips? 20 pips. Okay. And then you would have made how much? 4% in a day, in 2 days rather. And then let's, in how many days? This is 1, 2, 3, 4. So at this point, we're making 10%, which is powerful. So this is a swing trade. Swing trades last for days and weeks, like 2 weeks, 3 weeks. So holding this trade for, let's say 1, 2, 3, 4, 5, 6, 7. Okay, 7 days. That's almost a week because market retraced here. I see market retracing. Okay, market continued down. So if you hold it 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22. That's almost a month. That's almost a month. Holding it for price to take this sell side liquidity. That's still a swing trade. So now we can see how we could enter from our breakout block that was gotten from the 4-hour time frame. Very easy. I'll come again with it. Step 3. You want to see market hitting the breakout block in a certain time zone above the market open, protracting against the intended move, and then you want to put your stop using the Asian range deviation. So how can you set your fib? Let me just show it to you. So this is the fib. These are the settings. So you can just go to your fib and impute these settings. Pause the video and then impute these settings, and then you will have something like this. This is how you get your range. So if you just put it here, it gives you the standard deviation. This is 1, this is 2, this is 3. And market does not go above 2 to 3 standard deviation for a day. If it goes above it, then market wants to actually rally in that direction. I don't know if you understand. So let's use this one. Let's use this day. So let's assume market hits it in this day. You can see that price is above market open. So where's the market open? This at this point here. Market opened here, hitting it at what Q zone? The New York Q zone. So you draw your fib from this point to this point. So you can see this is the range here. So you put your stop here. Now this makes it more mechanical. You don't guess where your stop will be. You just know that, okay, it's a standard deviation. Sorry. Your entry will be here. And then your stop will be here. So it's how many pips? 28. Here was, I think, about 20. So it's just similar to entering here. So if you'd have entered here, you won't have been stopped out. So you don't want to enter here and then put your stop here, somewhere here, or here, or here. You just want to put it above the breaker range. So you can see how market rallied downwards. So if you couple this with your risk management, you'll be able to attain huge amount of profit. Mind you, what you want to be doing is you want to be taking partials. Now let's assume you entered here from this point here with 50 lot size. You want to be taking like 20% as price runs the low. Now it depends on you. You can take out 20%. Like I love taking out 20% from my trades, like 20. You can take 20 here, 20 here, then collapse the trade at this point. Or you can just take 10 here as price takes this low, then 20 here, then leave the rest to rally downwards. And as you are taking your partials, you are moving your stop loss, because you don't want to be in a trade where market, imagine you put your stop loss here or somewhere here, and then market rallied down, you were in profits, then reversed, took you out. You understand? So if you enter a trade, as you are taking partials, you are moving your stop loss. You are going to benefit hugely from that trade if you trade like that. You don't just leave your stop there for months. No, you want to be moving your stop loss. As price is going lower, you're moving your stop loss. And you're not just moving your stop loss anyhow, you're moving your stop loss with your understanding of price action. All right. So with time, I'm going to be teaching that with strategies. So I hope this lecture added to your repertoire of tools to make you a profitable trader. And if this helped, I would like you to give this video a thumbs up and subscribe for more content. And as always, I wish you all good luck and good trading.